Good morning. It's great to be here. Thank you so much for having me. It's a real thrill to be able to get to speak to you all this morning and be able to share some of our insights. So I hope that coffee's kicked in because I'm about to probably bombard you with charts. It wouldn't be an Economist update without a lot of charts in this slide deck. So yeah, hoping that coffee has kicked in. So I'm going to start off with a bit of a snapshot of the Australian economy. I'm going to give a bit of a roundup of where we're at, some of the key themes right now, followed by a bit of an outlook of what we're expecting. That's where I'm going to try and dust off that crystal ball and give you our thinking on the outlook for the economy. Interest rates, of course, I'm sure that's the all-important question on everyone's mind. And here's where I'm going to add that little or all-important disclaimer. For those of you that don't know, economists were invented to make weather forecasters look good. So I'll leave that there. And then if we've got time, we'll move on to housing market trends. So that's kind of what we do best at REA Group. It probably wouldn't be an update from the realestate.com senior economist without a bit of a touch on the housing market, some of the key themes, a little bit around the rental market as well, and a bit of an outlook for housing too, if we get time, of course. So without further ado, I will get into the session and the deck. If we can bring the slides up, please. Sorry? Oh, okay. Sorry, my bad. All right. So where are we at with respect to the Australian economy right now? We know that we've just been through a very kind of turbulent period. We've come out the back of a global pandemic. And since May 2022, we've seen a significant tightening in interest rates. And that's certainly impacted the economy and it's impacted households and, of course, spending. So at the moment, we're facing a situation where the economy is continuing to grow, but barely growing. Although the good news is we're not in a recession and we're not looking at any particular risk of a recession in the near term, but we have been in a per capita recession for quite some time. So on a per capita basis, so talking about a per person basis, the economy has been moving backwards for 6 consecutive quarters. Now, that's actually the longest per capita negative growth run on records available from the Australian Bureau of Statistics going back to the 70s. So with population growth having been historically strong and, of course, spending growth slowing with this significant tightening in interest rates that we've seen, the economy on a per capita basis has been going backwards for 6 consecutive quarters. Now, breaking down a bit of what's driving economic growth at the moment, we've got public demand, so government spending now represents around 30% of GDP growth, which is economic growth. So that's above the decade average of 23%. And meanwhile, private demand, so demand from households and consumers, is very weak. So we've got this situation, I guess, where economic growth has been somewhat propped up by population growth, but also government spending. So when we look at the consumer, we can see that consumers have really cut back. So household spending in the June quarter fell 0.2%, and we can see that consumers are really cutting back on discretionary spending. So that's anything that's non-essential, so eating out, travel, all of those sort of things. That people are going, my mortgage rate has increased significantly, my repayments have increased, I'm going to prioritise my mortgage repayments. We know that most Australian households are on variable interest rates, so they have seen that adjustment in interest rates flow through to mortgage repayments. And as a result, people are cutting back on discretionary spending. But we are starting to see also that households are pulling back even on the essentials. So actually, when we break down that June quarter GDP data, we can see that a fall in real spending on food even kind of highlights, I guess, how households are adapting beyond just pulling back on discretionary spending. So purchasing lower cost white label products, for instance, over branded food products. So really starting to cut back on essential spending as well. So whilst that may all sound pretty negative, really the economy has remained pretty resilient in the face of such a significant tightening in monetary policy. Now, a lot of that is largely due to the strong entry point after the pandemic. And the good news is we feel that this kind of June quarter was probably the nadir when it comes to economic growth. So we're expecting an improvement in conditions over the second half of the year with easing inflation, so easing cost of living pressures, and of course those tax cuts taking effect as well, albeit we're expecting growth to remain well below historic trends, although probably picking up a little from here. So moving on to the labour market, we know that the labour market has really been, I guess, a ray of light with respect to the resilience of the economy and the resilience of the labour market, which is still relatively tight. So we know it's been the third month in a row in October that the unemployment rate held steady at 4.1%. So unemployment certainly still remains low by historical standards and really relative to our developed economy peers. But it has softened since a year ago. And it will continue to soften. Employment is continuing to grow, but it is slowing. But it does certainly remain strong relative to the growth slowdown that we've seen. And how's that translating, or that kind of relative tightness in the labour market, how that's translating into wages growth and, of course, household income growth. Now, wages growth has been a little bit softer than expected, so both over the past quarter and the past year. And we're seeing that wages growth is the weakest in Victoria and South Australia. That makes sense. That's where unemployment rates are also the highest at the moment. Now, this wages growth data should give some comfort to the Reserve Bank that potentially that fall in services inflation, which has been a little bit slower, should start to accelerate over the next 6 months, helping to bring inflation back in, or sustainably back into the RBA's 2 to 3% target range. Although the trade-off here with wages growth being slightly weaker than expected is also a potential dampening in the consumer recovery. So zooming in on the consumer. The consumer mood is actually recovering. So there's a number of factors here that are kind of playing into this slight recovery that we've seen in the consumer mood. We know that for the past couple of years, since interest rates have moved substantially higher in 2022, consumer sentiment has really been dominated by a really distinct pessimistic outlook. And we can see in the latest consumer sentiment reads that actually the outlook for economic conditions, for family finances and the like is starting to creep higher. And that's certainly good news and plays into that kind of that theory that potentially that June quarter was that nadir or turning point in terms of economic growth. Certainly the consumer mood at the moment is being buoyed by resilient labour market conditions, tax cuts that came into effect in July. And of course, consumers are no longer worried about further interest rate rises. The conversation has very much moved on to when interest rates are going to start to fall. So that's been another factor buoying consumer sentiment at the moment, and the mood does look to be improving. Now, in the November consumer sentiment survey, there is some questioning included around the outlook for Christmas. And again, this also points to a recovery in the consumer mood, with a lot less consumers saying they're going to cut back on spending over Christmas relative to last year. So we can see that on the chart on the left here in terms of consumer sentiment improving. Now, what we've got on the right probably just looks like a load of numbers and gobbledygook to you guys, but I'll break it down for you. So it's another thing that the RBA will have been watching quite closely, which is the spending response to the tax cuts that we've seen earlier this year. And so far, what we can see in terms of analysis of consumer spending data is that a large portion of those tax cuts are being saved and not spent. So analysis of this data shows that actually the marginal propensity to consume from the tax cuts, so to spend that additional dollar that the consumer is receiving, is sitting at around 0.16 at the moment. So that means that households are only spending about 16% of that boost to their income and saving the other 84%. So this, again, probably welcomed by the RBA, who were somewhat nervous or cautious around the upside risks to inflation that might be generated from any boost or lift in consumption that would occur from those tax cuts kicking in. But it does also, I guess, add to a little bit of the uncertainty around the outlook. So this is very much a choice to save and not spend. So it does add some uncertainty with respect to the fact that the consumer sentiment or consumer mood is improving. So how will that impact, I guess, over the next 6 months, that marginal propensity to consume those additional dollars? So again, looking at some of the data that we received in this latest consumer sentiment survey. Now, responses to the consumer sentiment survey did show a pullback over the week after the US election. So the survey data is collected over a period of time that actually captured the US election results and enabled economists to kind of break down the sentiment or mood before and after US election results. And I thought, it probably wouldn't be a great update to you guys today if I didn't focus a little bit on what the outcome of the US election might mean for the Australian economy. I'm sure it's something that's relevant and a question that many corporates in Australia are facing at the moment. Now, I will caveat that most of what we can say at the moment is speculation for now. And really, economists all over the world are kind of grappling with what this means. And I guess the key takeaway here is a lot of uncertainty. The big one is clearly tariff risk. We know that that is likely to be inflationary in the US, although there is a bit of a trade-off there with lower growth as well, which could potentially dampen that inflationary risk. But also another impact is lower growth in China, and that spillover to the APAC region as well. So we know that this time around, the Trump presidency is also less constrained. The caveat there is that historically, Trump has kind of seen financial market performance as a bit of a barometer of his success. He's heavily influenced by financial markets. So if financial markets don't like what he is proposing, he has been known to whipsaw and pull back. So it's very hard at this stage to know what is brinkmanship and what is not, and what may be subject to change and what may not be. But at the moment, the proposals are a 10 to 20% tariff on all goods imports and a 50 to 60% tariff on goods from China. So certainly some really kind of harsh proposals there in terms of ramping up or intensifying global trade war risks. Now Australia, as a relatively small open economy with high trade exposure to China, we are certainly vulnerable to those risks. And likely in the scenario that we do see an intensification of global trade war risks, that does probably point to a lower growth outlook for Australia. With respect to inflation, though, this is where it could get quite interesting. So if we do see this kind of supply glut scenario in China, whereby the US is importing less from China, that could actually export somewhat of a deflationary pulse. So it could mean that actually inflation moves lower a little bit quickly or a little bit more quickly here, and actually accelerates the profile for interest rate cuts, particularly with that lower growth risk that comes from that intensification of trade wars. But really, the main takeaway is uncertainty on kind of the policy front, the trade front, geopolitics. But what there's probably no doubt about is the fact that a global trade war would be negative for global growth, and certainly Australia, we're not immune to those spillover risks, particularly from a growth slowdown in China. So where does that leave us on interest rates? Now, we know that inflation is continuing to move lower. In fact, headline inflation has moved back into the RBA's 2 to 3% target range. But at the moment, it's underlying inflation that the RBA are really focusing on. So we know that headline inflation is trading down. It's been aided by electricity rebates and other cost of living relief measures that have been implemented by both federal and state governments. So it's not reflective of underlying price pressures in the economy at the moment. And as a result, we're going to continue to see the RBA kind of look through that headline inflation measure. and really focus on what is at the moment a too strong underlying inflation. So at this stage, we are expecting that inflation is going to continue to move lower, and probably those underlying price pressures might move lower a little bit quicker than the RBA are thinking. And we're looking at the first quarter of 2025 at the earliest for interest rate cuts. Although things can change very, very quickly, we know that really this year, interest rate expectations have been on an absolute roller coaster ride. If we cast our minds back to kind of January, February, March, a lot of major forecasters, a lot of people were thinking that interest rates were going to begin to move lower in the second half of this year. Clearly that hasn't happened. And really, that's a good thing, you know. That means that the economy has been more resilient than expected. Certainly the labour market has been more resilient than expected. Unemployment has been much slower to move higher than many expected. But certainly we are thinking that unemployment, as it begins to drift higher a little bit more quickly over the next 6 months, and those underlying price pressures also begin to fade a little bit more quickly, that probably we're looking at interest rate cuts sometime in the first half of 2025. We're thinking at the moment the absolute earliest could be February 2025, but it's probably much more likely that that timing is pushed out to May at this stage, unless something changes over the next few months. So I'll wrap it up a little bit on kind of where to for the economy before moving on to a little bit of a snapshot of the housing market if we have time. Which I think we might not. So I might open up for questions after this. So household spending is expected to increase. We know that real incomes are rising as tax cuts take effect. We've also got easing inflation and cost of living pressures playing into that uplift in real incomes as well. So we're expecting that the June quarter was likely a bit of a turning point with respect to the outlook for economic growth. We do have probably some upside risks as a result of potential fiscal stimulus. We know that there's going to be a federal election called before the 17th of May next year. So in a landscape that at the moment is really dominated by cost of living pressures, it is likely that we're going to see some more voter-friendly policies put on the table, which also presents a little bit more of an upside risk for household spending as well. But still, we know that despite the resilience of the labour market and household spending, it's not likely to increase quite as quickly as expected. I think a lot of people were expecting the uplift from tax cuts to be quite a bit more than expected. And as you can see, we've kind of just been through that marginal propensity to consume was really only at 16%, with most consumers choosing to save that remaining portion. And that does likely mean that the outlook for inflation is one where those underlying price pressures do start to move back towards the RBA's target range sustainably a little bit more quickly. And certainly heightened geopolitical risks at the moment add to that uncertainty as well. So I might wrap it up here. I think we don't have time for that little bit of a housing outlook, and I'll open the floor for some questions. So certainly immigration has been a big factor over the past couple of years. We know that population growth has been incredibly strong, and that's been, I guess, a large driver behind that kind of per capita economic growth recession that we've seen for the past 6 consecutive quarters, with population growth really fueling or bolstering economic growth to a certain respect. Population growth has also played an impact in the housing market at the moment. We know that we've faced this kind of chronic shortage of housing over the past decade or so. We haven't built enough new homes, and as a result, we've seen a factor where population growth has surged, and rental markets have been incredibly tight as a result, and house prices have continued to rise over the past couple of years, despite interest rates being a lot higher and borrowing capacities have been reduced by around 30%. And of course, that increase in housing costs has also flowed into inflation and the persistence that we've seen in terms of inflationary pressures. So immigration at the moment, I guess it's somewhat of a hot topic, and we have seen that that has posed some challenges in terms of looking at housing markets, largely because we haven't, or because we've got these kind of supply issues in terms of planning and zoning restrictions and the like, where we really haven't sought to meaningfully address that chronic shortage of housing. And therefore we've seen that increase in housing costs really kind of flowing into the persistence in inflationary pressures at the moment as well.
We do have one question on Slido, actually, which is, I know there was some data that came out in terms of, I live in Melbourne, some of the richer suburbs in Melbourne, the number of mortgage-free, like cash-bought properties was incredibly high. And the question on Slido is in relation to, is there a sense of sort of the rich getting richer and the poor getting poorer? Is that sort of a general trend that you've seen in the last couple of years?
It's certainly an interesting question. And I think when we really kind of break down, I guess, spending data at the moment and look at kind of households that have been more resilient and those that have not, we can see that certainly it is younger Australians that are really bearing the brunt of this increase in interest rates, and younger Australians that are bearing the brunt of the decrease in household spending, whereby older Australians who maybe more typically own their home outright have felt less of an impact with respect to the significant adjustment in mortgage repayments, but also have entered this period in a better position. So we know that a lot of those older Australians who potentially own their home outright have also seen sizable equity gains in terms of the substantial appreciation in house prices since the onset of the pandemic. National house prices up around 40%. So that means that a lot of existing homeowners are sitting on sizable equity gains, and that's been one factor behind the resilience in the housing market as well, actually, is those buyers that aren't impacted by interest rates. And who are more likely to be cash buyers or buyers with smaller mortgages, leveraging those equity gains in their existing home.
And currently is a very hot time for properties. This is the important time of the year. Are the listing volumes as healthy as you'd expect at this time of year, just generally?
So certainly it's a busy period for housing markets. We know that we're kind of coming towards the end of the spring selling season. And we've really seen a substantial uplift in listing volumes. So a lot of that speaks to heightened seller confidence. At this stage, we know that national home prices have cycled through 22 consecutive months of growth, and sellers are certainly confident in listing their properties for sale after that substantial increase in house prices that we've seen over the past 4 or so years. But what that increase in listings volumes does mean is that there is a lot more choice for buyers at the moment. It means that buyers can be a lot more picky. They can take a bit more time to choose or to find a property that's right for them. And as a result, we have seen that home price growth has slowed quite sharply and quite significantly. Now, that's been particularly the case in Sydney. Melbourne has underperformed for quite some time now. And then you've got those smaller capital city markets like Brisbane, Perth and Adelaide, where stock is still relatively constrained and prices are growing at a faster pace.